Friends, how are you? By blessings of the God, you are doing well. Once again, I am welcoming to all of you to Dr. A B JENA classes. This is Dr. Jena, Senior Assistant Professor, PG Department of Business Management, Fakir-e-Mohun University, Besa Bihar, Balasore, Odisha. So, without wasting our valuable time, we will start today the most interesting part in financial management. So far as the financing decision is concerned, so we are going to discuss about the capital structure. So this is the very important to the business point of view, or to all types of organization, whether it may be the large scale business organization or medium scale business organization or the small scale organization structure. Okay, so right amount of the fund or the finance must be needed by a business organization. If it will be the inadequate, then the business will suffer. If after getting the right amount of the fund or the finance or the capital, if the business organization does not utilize properly, then the whole organization will suffer. Okay, dear friends, without delay, we'll start today our academic journey, that is the capital structure. Okay, so capital structure, and today also after discussion of the meaning of the capital structure, then we will discuss the various important factors or the determinants, so they normally influence the capital structure. After that, we will discuss one by one the important factors of the capital structure, so they normally influence the capital structure. Okay, so capital structure here we will discuss before discussing the capital structure, then what is the meaning of capitalization, what is the meaning of capital structure, and what is the meaning of a financial structure, and what are the different forms of a capital structure. Okay, so dear friends, so before discussing, just you take one screenshot. Yes friends, okay, what is the meaning of capitalization? So capitalization means capitalization refers to the total amount of securities issued by a company. Let's take an example. Suppose you are you are owning one company. Your company will issue the what are the amount of securities. Security means so these are the equity share, preference share, debentures, and other long-term debts, etc. So these are the securities. Yes. So capitalization, it refers to the total amount of securities issued by a company. Then come to what is the meaning of capital structure. So capital structure, capital structure refers to the kind of securities. What are the kind of securities? It may be the equity share, it may be the preference share, it may be the debenture, and other long-term securities normally a company issues. Then capital structure, it refers to the kind of security and the proportionate amount that make up the capitalization. Okay, by citing the suitable examples, then you will be clear about what is the meaning of capitalization, capital structure, and the financial structure. Okay, again the capital structure, capital structure consists of long-term debts, preference share capital, equity share capital. Okay. PRF, it's the preference, S it stands for the share. So it's the capital structure consists of long-term debts, preference share capital plus equity share capital. Okay, again what is, so it's the capital structure, it's the total assets minus the current liability. Okay, dear friends, just you recall the balance sheet. So balance sheet, there are two sides. So left hand side it's the liability side, and the right hand side it's the asset side. So total assets minus the current liabilities. If you will deduct the current liabilities from the total asset, then you will get the capital structure. So capital structure is the sum of the ownership capital and the borrowed capital. Again I am repeating. So capital structure in mathematical equation is equal to what is this? That is the ownership capital plus the borrowed capital. Okay, what is the meaning of a financial structure? So financial structure means the entire liability side of a balance sheet. So this is the balance sheet of a company. So these are the liability side. The total will be the financial structure. Okay, so then what are the forms of capital structure? So normally you will find, so these are the forms of capital structure of a company. It may be the company may issue the equity share, or it may be the capital structure may be both the equity share and the preference share, or your capital structure will be the equity share and the debenture, or it may be the equity share, debenture and the preference share. So normally we will find, okay, so this is the form of the capital structure of a business organization or of a company. Okay, just by citing for example, so it's the imaginary, okay, example of a company. So it's of a company by citing or by taking the imaginary figure, then easily you can clear about the capitalization, capital structure, then the financial structure. Okay, so first one is, what is the meaning of capitalization? Capitalization means what is this total amount of securities issued by a company. So your company has issued which what securities? Equity share. Equity share is how much? 5 lakhs. Then the preference share, it's how much? It's the 2,50,000. Then the long term debts, LT, long term debt, long term debts and the debenture, it's the 5 lakhs. So total will be how much? Capitalization, it's 5 lakhs plus 2,50,000, 7,50,000 plus 5 lakhs, it's total the 12,50,000. It's the capitalization. I hope I am hopeful now very clear. Come to the capital structure. So capital structure is that is the proportionate. I mean it's the mix. So here, so equity share capital is how much? It's 5 lakhs. Then the preference share capital, it's 2,50,000, and the long term debts and the debenture, it's 5 lakhs. So total is how much? 12,50,000. And when we will convert into percentage, so total, so it's with the equity share capital is how much? 40%. So it's 5 lakhs divided by 12,50,000 into 100. Then you will get the result, that is the 40%. Similarly, so preference share capital, it's the 20%. 2,50,000 divided by 12,50,000, so you will get the result. Okay, so 20%. Then long term debts and debenture, it's DEBT, it's DEB, it stands for debenture, it's the 40%. So total is how much? It's the 100%. Okay, dear friends, come to the what is the meaning of or from this imaginary example. So what will be the financial structure? So financial structure will be, what is this? 20 lakhs. Okay, what is the meaning of financial structure? Means financial structure means the entire liability sides of a balance sheet. Yes, it's the liability sides of a balance sheet. So total is how much? So here you have to add the retained earnings as well as the current liability. So total is how much? It's the 20 lakhs. Okay, dear friends, now we will jump over to the what are the important factors or the determinants. So they are or they normally influence the capital structure. So we will discuss one by one the determinants of a capital structure. Friends, so now we will discuss what are the important factors or the determinants. So they normally influence the capital structure. They may influence the capital structure. So as we know, the objectives of the business is not to maximize the profit, but also a business will maintain the or maximize the value of the firm and the market price of the share. It is. So dear friends, first you take the screenshot. I have written there are 17 factors, so they influence the capital structure. So whatever the capital structure or the mix of both the equity financing and the debt financing, or the mix both the ownership capital and the borrowed capital, ultimately, so almost all the companies or the business organizations or the business undertakings, they try to enhance or the maximize the value of the firm and the market price of the shares. Okay, dear friends, now we will discuss one by one the factors. So they usually influence the capital structure. So these are the 17 factors. So these are so first one is that is trading on equity. Or trading on equity, it's known as the dusra name of trading on equity. It's the financial leverage. In another video, we will discuss in detail what is leverage, what is the kinds of leverage, that is the financial leverage and the operating leverage. So dear friends, so you have to always remember, and frequently you will get the question, what is the meaning of trading on equity or the financial leverage, not only in the exemption but also in UGC, NET and JRF exemption, as well as in a lecture series, interview or the viva, you will get the question, what is trading on equity, or it's known as that is the financial leverage. So dusra name of trading on equity, it's the financial leverage. Okay, what is this financial leverage? The use of LT. LT stands for long term fixed interest bearing debts and the preference share capital. So here, as we know, the debts, the debenture holder as well as the preference shareholder, they will get what? The fixed rate of the interest as well as the dividends. Okay, along with the equity share capital known as the trading on equity or the financial leverage. Okay, so here if the capital structure will be increased, so whether the earning per share will be EPS, it stands for earning per share, and what are the the impact or the consequences of leverage in separate separate video we will discuss the leverage. Okay, so trading on equity or the financial leverage. Come to the second one factors, that is the stability and the growth of the business. As we know, it's the another objective of business, that the growth, development, monetization, expansion of the business. Yes, what is this? If there will be the greater the rate of sales volume or the turnover, if the turnover will be more, then that will be the greater use of the debt financing. If the sales or the turnover will be more, the business organization will prefer the debt financing. If it's the fluctuation, there should not be the debt financing. Right now, what is okay? So that is in the COVID-19 situation and the war between the Russia and Ukraine. So there will be the fluctuation. So there will be the fluctuation. So in this situation, you will prefer the debt financing. Debt financing means you will issue the debenture and other or the public deposits or other the long term or medium term financial instruments, which we have already discussed in a separate video. Okay, so stability and growth. If there will be the more sales and there will be the more or the greater growth, in this situation you will prefer which one? The debt financing. If there will be the fluctuation and there is the decline of sales, so in this situation you will prefer which one? The equity financing. Equity financing means your business will issue the equity share to the general public. Okay, dear friends, so during our discussion, you feel or you assume that you are the finance manager of your business. So when you will enhance the capital structure or the capital, so what you will consider? So you will consider these important factors as you are assume that you are the finance manager. Okay, so next one is that is the cost of capital. Yes, so here cost of capital, that is the proptiornate questions. What is the meaning of cost of capital? So cost of capital, it's the minimum rate, AMIN, it's the minimum rate of return expected by the investors or the supplier of the money. So here, as the business should make the strategy to minimize the cost of the capital. If the cost of capital will be more definite, and in this situation, so you should not go for the more, okay, the debt financing as well as the equity financing. So next one is that is the nature and size of the business will also influence the capital structure. See here, the nature and the size of the business. So nature and the size of the business, whether it may be the small scale business organization, medium scale organization, or the large scale business organization, or the nature whether it is your business is related to the service oriented sector or the manufacturing oriented sector. So the nature and the size of the business may influence the capital structure of the business. So next one is that is the feasibility. Feasibility means that is the scope. I mean, so you can change the capital structure. you can change the capital structure. So here what we will do, or there should be the scope, to raise the additional fund. So you will raise the additional fund, I mean you will enhance the capital structure whenever needed by a business, BUS business, without facing much difficulties as well as a delay for profitable projects and the investments. As we know, suppose tomorrow, so there will be the perfect or the favorable business environment, the favorable market situation. So in this situation, you have to, or your business will enhance the capital structure. So factually, the scope should be there. Next one, the factors of capital structure is that is the cash flow ability to service debt. If a business is able to generate more and stable cash inflows, if a business will able to maintain or generate more and stable cash inflows, then in this situation your business or the business can employ the more debt. I mean the DEBT, debt, it's a, that is the debt financing in the capital structure. If the cash inflow will be more and more, so in this situation you must prefer, or you should prefer the debt financing. So next one factor is it's the control. So control in the sense, the management of a business or a company should raise the should raise the additional fund. Additional fund means that is the finance for the investment purposes without any loss the control over the business or the firm. So I mean, so in this situation, if you will raise the equity financing, so that the controlling, I mean the rights of the existing shareholder may not be diluted or should not be affected by raising the additional the fund. Next one factor is the requirements of the investor. So requirements of the investor always. So a business should take care of the interest or the requirements of the investors. What is this? So it is necessary to fulfill. It is So it is necessary that a business should fulfill or reduce the gap of the investors. Both the investors, so far as our discussion is concerned, so normally there are two types of investors: the institutional investors and the retail investors, while debt financing rates. So retail investors, that is the common man, you, myself, and your friends. So they are the retail investors. Who are the institutional investor? It may be the Reliance Industry, it may be the Tata, it may be the Birla, it may be the Dalmia, or it may be the and other organizations. So they are known as the institutional investors. So they know. So far as there are two categories of investors. Again, so in the case of individuals, so there are three types or three kinds of investors. So first one is it's the bold investors. Second one is that is the cautious investors. Next one, or the last one, is that is the less cautious investors. The bold investors means the bold investors are those investors. So they are ready to take the risks and they will prefer the equity share for the purpose of they will get the more capital gain. So I will suggest you should be the bold investors, and you have to wait for the long period, and you will ultimately get the more capital gain out of the investment. So second one category of investors, so they are the cautious investors. So they prefer normally the safety investment and the stable or stability of a return, and they prefer the debenture always. They prefer the debenture. So last one is they are the less cautious investors. So they prefer what? They prefer the stable return. And share the profits and take normally the preference shares. So dear friends, so normally the three categories of investors. So far as that is the retail investors are concerned. So they are the bold investors, cautious investors, and the less cautious investors. Bold investor always they prefer the equity share for the purpose of getting the capital gain, and the cautious investors, so they always prefer to take the debenture for the stable or the stable return as well as the safety investment, because the debenture holder the debenture holder will get what? The fixed interest. And the less cautious investors, so they always prefer what is the preference share, because the preference shareholder they are getting, or they will get the fixed rate of dividend. Come to the next one, it's in the capital market conditions. So capital market conditions, so always it's the volatile. Now that is what is the condition, capital market conditions. So after in between the war between the Russia and Ukraine, as well as that is the COVID-19 situation. So here if the share market, share market, that is the BSE and NSE, National Stock Exchange, and the Bombay Stock Exchange is depressed and unfavorable business environment. BOS is the business and ENBT, that is the environment. So your company or a company should not issue the equity share, and in this situation, your business should adopt the debt financing in capital structure. If the reverse sides in the boom market, MKT, that is the market or favorable business environment, the company or your company should your company should issue the equity share. And according to this the capital market conditions, so the capital structure will be the maintained, or the capital structure will be determined. Next one is that is the asset structure. So capital market is a market where the long-term securities are traded. I mean, long-term securities are sold and purchased. Who is the regulator of the capital market? I have already posted one video about the capital market. Who is the leader? Who is the captain? Who is the the regulator or the leader of the capital market? The SEBI, Securities and Exchange Board of India. Next one is that is the asset substructure. If more investment into fixed assets, there should be the more capital structure. You know, dear friends, what is the fixed assets? So fixed assets are those assets which are required to enhance the earning capacity of the business. I mean the profitability positions of the business. Then come to the degree of a competition. Degree of a competition. So there are two levels of competition. One is that is the low competition, and another is that is the higher competition or the more competition. So far as a business point of view or the business environment, so that is the tough competition in between the competitors. So it's that is the same, आगे भी खतरा, पीछे भी खतरा, बाएं भी खतरा, दाएं भी खतरा. So in this situation, how will maintain or determine the capital structure in low competition? If there is the low competition, then in this situation you or your business will prefer what is this more debt financing as compared to the equity financing. If there will be the more or the higher competition in this situation, so the more equity financing will be in where or in capital structure. Then the purpose of financing. The purpose of financing, this factor, if the funds are required for the productive purposes, so in this situation the business will prefer more debt financing in capital structure. If the funds are required for the permanent or the developmental purposes, so in this situation, so there should be the more equity capital in a capital structure. Then the period of finance. So period of finance, it's the short period. Another is that is the longer period. If it's a short period, it means the 5 years, 7 years or 8 years. So in this situation, there should be the more debt capital or the preference share capital in the capital structure. If it is for the longer period, more than 10 years, 15 years, 20 years, so in this situation, there should be the proportion, the mix. There will be the more mix of equity capital in where capital structure. Next one is that is the cost of flotation. Cost of flotation in the sense when your business will issue the shares and debentures, so you have to pay some expenses or the cost. It may be the underwriting commission, it may be the preliminary expenses, it may be the legal expenses. Yes. So far as the issue of the equity share or the debt financing. So normally it's less in where the debt. If the cost of flotation is less, then in this in this situation, then you will prefer which one is that is the equity capital. If the cost of flotation is more, so in this situation you will prefer more the what is the debt financing. So next one is that is the personal consideration. What is this? The practice makes a man perfect. Practice makes a man perfect. So there what happens? The personal consideration of who? The management team of the management, board of directors or managing director or the manager. The personal consideration and the experience and expertise of team of management may influence the capital structure of the company. So you will analyze what would be happen tomorrow. Accordingly, the capital structure will be more or less. So next one is that is the tax benefits. So tax benefits, it's very vital or the important so far as that is the determination of a capital structure. If there will be the high rate of corporate tax, or the high rate of corporate tax influence the company CEO company to prefer the debt financing. If the that is the corporate tax rate is more, so in this situation company will prefer which one? The debt financing as compared to the equity financing for the purpose of wealth maximization. Wealth maximization, it's that is the value of the firm as well as the market price of the share. So wealth maximization will influence or will maintain the more the value of the firm and more market price of the share. Last but not the least, it's that is the legal aspects. Legal aspects. So here the debt equity ratio. So SEBI guidelines are there. Who is the leader or the captain of the capital market? The SEBI. So as for the SEBI guidelines are there. That your business will maintain or will follow or abide by the rules and the regulations some given by the SEBI from time to time. Here the debt equity ratio does not exceed what is this 2:1. If the debt will be the 2 lakhs, then the equity what is this 1 lakh. So 2:1 for the intensive projects. And the ratio of preferred share capital does not exceed what is this 1:3 at any cost. And another that the SEBI guidelines are there. Promoters holding will be what is this 2.5% on the equity capital. So dear friends, I am hopeful so you have learned a lot, and these are frequently you will get the question: what is the meaning of capitalization, what is the meaning of capital structure, what is the meaning of the financial structure, and what are the important factors. So they usually normally influence the capital structure. So I am hopeful so you have learned a lot. If you like this discussion video lecture, kindly you subscribe it, kindly you forward it, kindly you share it, and if anything I mean the discussion is left, kindly you drop your ideas or views in the comment section. So once again, thanks a lot to all of you.